Hello, everyone, and welcome to Newfront Frameworks presented by Connect. Connect is a San Diego nonprofit with over 3 decades of experience in helping innovation entrepreneurs scale their businesses through our various programs, resources, and events. For more information, please visit our website at connect.org. A quick note, there will be a Q&A at the end, and our experts are available in the chat. Now, at this point, I am pleased to introduce Jeff Simpson, Senior Vice President at Newfront. Welcome, Jeff.
Thank you, Val. Much appreciated. Hello, everybody, and good afternoon. Thank you so much for joining us here today, and we're very excited to bring you this framework session. Newfront is a partner and sponsor of Connect San Diego. I myself am a board member with Connect, and we are honored and excited to be here with you today. Just quickly, Newfront, we are a full-service insurance brokerage. We do business in all 50 states and globally, headquartered in the Bay Area with offices throughout the country. Newfront specializes in risk management and commercial insurance, total rewards and employee benefits, and retirement services. But most of all, we're consultants and advisors to your businesses. If you need anything from Newfront at all, there'll be contact information at the end of the session, and we would love to have a discussion with you and see how we can help. At this point in time, I'd like to introduce my colleagues and your presenters today. First off, we have Jake Daly, Vice President of Retirement Services, and Michael Forney, Senior Financial Wellness Specialist. Gentlemen, welcome, and I will turn it over. Take it away.
Hey, thanks a lot, Jeff. Everybody, thank you so much for joining today. We could not be more thrilled to be here with you. As Jeff mentioned, so my name is Jake Daly, Vice President here of Retirement Services at Newfront Retirement Services, and our focus here in our role as in retirement services as an advisor to our clients' 401k plans, predominantly around the investment fiduciary work with their 401k plans and everything that spans in between that. Now, Michael is a key pillar of our team. He works alongside me and the rest of the broader team here at Newfront Retirement Services in deploying education and financial wellness strategies for our clients as part of the broader work that we're doing around 401k engagement. We're going to talk to you a little bit about that work, how we're working with our clients within Newfront Retirement Services, the services that we offer. We understand that there's probably a mixed bag of you that are on the call today. Many of you may be founders of organizations. Many of you may be working with those organizations to help to stand up their retirement plan offering. Some of you may be participants inside your own 401k plan or have individual retirement accounts that you are participating within. And so we want to make sure that we're providing you some takeaways, including the 2025 IRA and 401k limits. And Michael's going to broadly take you through that. But first, we want to start off just by introducing ourselves and our team. So as I mentioned, Michael's a key pillar of our team, but we are actually 30 individuals within our retirement services practice that span anything from investment operations and investment advisory to mergers and acquisitions and M&A advisory specific to retirement plans. We also have and are very lucky to have in-house ERISA counsel and a chief compliance officer that work alongside myself and my account executives that support me with my clients around really the complicated nature and the highly regulated and legislated environment within the qualified retirement plan space, predominantly the 401k plan space. So we're a really dynamic team. We're really able to help our clients across the broad spectrum of things that can come up within the retirement plan space. And as I already mentioned, Michael works alongside us to make sure that we're also engaging with employees to help them to most maximize their retirement plan benefit that their employers are putting out in front of them. You can see the consultative approach that we take within Newfront Retirement Services. This is going to span a whole gambit of services across investment advisory, ongoing provider negotiations. This is really more around fiduciary governance and the way that we are supporting our clients in the ongoing fiduciary governance process. So fees and investments are the two things that are top of mind there. We also really act as a point of escalation for our clients in the interfacing with the retirement plan providers. We're also supporting our clients, the stakeholders, whether it's within the executive team or the HR and finance teams that are owning the day-to-day of the retirement plan within their organizations around proper and prudent plan design, benchmarking, and making sure that we're operationalizing the retirement plan to make it easy to run and also is able to be maintained in a compliant manner on an ongoing basis. We do stand up, to use a word that we're seeing a lot of today, the framework for the fiduciary and governance process for our clients. That also includes adhering to current and then future compliance and legislative related environment changes. And then lastly, and this is really going to be within Michael's domain today when we get into the broader financial wellness space, we also support our clients around anything that is communication support or just the broader employee engagement and financial wellness initiatives. This can span anything from infographics and one-pagers to support our clients and their employees with their retirement plan offering, nuanced features within the retirement plan that we need some additional support on. We also have a robust content of library, in-person meetings, webinars that we also perform in a recorded fashion for our clients. So this is all to say that we are truly a full-service advisor and broker. But on our side, as an investment advisor, we're really focused on 3 key pillars. And I've already talked a lot about these things. Plan governance around the ongoing fee benchmarking negotiations, standing up the fiduciary-related documents and process for our clients, and then leveraging our in-house resources to make sure that our clients feel fully supported around anything that can ever come up with their qualified retirement plan. That also includes around things like plan design, employer matching contributions. When is the right and optimal time to be offering that to our organization? Can you support us from a cost perspective and helping us to understand how different structures and formulas for employer match are going to impact our bottom line and also benefit our employees? So we do support our clients through all of that. And again, the kind of core competency that our clients engage with us on is really around the ongoing investment advisory and insulating the company and the organization from the risk involved around the performance and the fees of the investments themselves that are being offered to plan participants within those retirement plans. But as I've already mentioned to you, and really to set the stage for Michael to take you through the broader financial wellness presentation that we're going to go through and make sure you all are leaving with some tips and tricks and rules for the road, whether you're a plan sponsor yourself, a founder of an organization, early stage or late stage, or you're just a participant inside your own retirement plan or a self-employed individual that is participating inside an IRA. Michael's going to cover all that with you, but we wanted to show you the way in which we engage with our clients around these initiatives specifically. So you can see that we support them around flyers and one-pagers and infographics. We also do live, recorded, and on-demand training for our clients, and that spans all kinds of different content. This can be retirement plan specific. This can be investment specific. And then Michael built out a very robust presentation for our clients and their employees around retirement readiness, talking about things that fall outside the domain of the retirement plan itself, but are on the periphery of retirement. Think of things like Social Security, retirement income, and then also Social Security and retirement income optimization. I'd say probably the most underserved part of the financial wellness space is really helping people to understand how to decumulate when they are approaching retirement. We all get beat over the head with how to save, but we don't always have those rules for the road of how to actually convert this nest egg and these retirement savings that we've worked so hard to accumulate into retirement income when we hit that retirement age, and more so as we're leading into it. We also have exclusive partnerships with outside financial wellness providers and vendors that bring traditional one-on-one CFP support to our clients. We also can accommodate for additional cost outside our advisory scope, one-on-one employee meetings or expanded group topics that maybe we don't have within our library today. So with all that said, I certainly don't want to steal Michael's thunder, so I'm going to have him come on and join me, and he's going to take you through the broader financial wellness and retirement plan overview. So Michael, I'll kick it over to you.
Thanks so much, Jake. Well, privileged to be here with you all today and excited to talk about some of the things that we here at Newfront can offer on the financial wellness side of things for your employees, for your businesses, to help you just optimize your overall financial wellness and long-term readiness for retirement or other financial goals that you may have. To start off, we're going to compare IRAs versus 401ks. Now, there are different IRAs out there. Like for businesses, you have simple IRAs, you have SEP IRAs. On the individual front, you have just a standard IRA account. And we like to compare this versus a 401k because oftentimes these two get a little bit confused, but there are some key differentiators that I think are important to be aware of. For one, IRA accounts, these are individual retirement accounts. This is one that you can open up on your own as long as you have earned income. You don't necessarily have to be working for a company and be sponsored by an employer to open up this type of plan. Whereas a 401k plan, this is an employer-sponsored retirement plan. The only way you can contribute to one is if you work for a company like your employer that provides you this plan. A couple other things to be aware of. You may be familiar with pre-tax, with Roth, like maybe Roth IRAs. Well, you can do pre-tax and Roth IRAs. You can also do pre-tax or Roth within the 401k plan in a lot of cases. And this is one of the things that we can help with on the advisory side when setting up the 401k plans to ensure an optimal benefit for employees. Couple other things that differentiate an IRA from a 401k. You'll notice that there are typically income phase outs pertaining to IRA accounts, whether that's your traditional IRAs as well as your Roth IRAs, whereas 401k plans typically don't have an IRA or don't have an income phase out. So you pretty much have the full flexibility to go ahead and participate in that. And then additionally, you'll find that yes, IRAs tend to have a limitless amount of investment options at your disposal, but bear in mind, you're going to have to decide how you invest or work with a professional to help you. Whereas a 401k plan, yes, you're limited in your investment choices, but these tend to be fairly low cost and, of course, have high-level fiduciary oversight from a team like Newfront to ensure that you have optimal choices at your disposal. So some key differentiators there, but at the end of the day, these are both retirement plans. They can both help you save and invest for the future. And then you'll also notice that they have differing contribution limits as well. On the IRA side of things, you can contribute upwards of $7,000 if you're under the age of 50, add an additional $1,000 if you're age 50 and older. For 401k plans, that limit's a little bit higher, upwards of $23,500. In fact, new contribution limits for 2025 did just come out. So as you can see, one of the other key differences is that if you're a company who's looking to implement a retirement plan, a 401k plan, one of its advantages is the inherent ability to offer increased retirement savings. And that's not even to mention the fact that there are also catch-up contributions available for those who are ages 50 and up. And there's also a new catch-up coming available in 2025, which we'll cover here shortly. Speaking to those contribution limits specifically, in 2025, the contribution limit for the 401k plan, Jake, I think we're on the next slide here. The contribution limit for the 401k plan is $23,500. That is an increase from this year here in 2024. The limit was $23,000. It will now be $23,500 in 2025. That to say that limits are subject to change due to cost of living adjustments. Every single year, the IRS evaluates the behavior of inflation over the previous year and tries to make sure that things are continuing to be fair and equitable based upon the current environment. So we do see that in 2025 on the 401k front, this contribution will increase. Sometimes limits don't increase. In the case of the catch-up contribution, here in 2024, the catch-up limit is $7,500. Here in 2025, the catch-up will remain $7,500 for those who are ages 50 and up. Specifically in 2025, did want to mention that there is a new catch-up provision that is coming available for a specific age group, specifically ages 60 to 63. And this is very compelling because this is one of the things that we here at Newfront really assist our employer partners with, is helping them understand the landscape of what's going on out there in the retirement space and what opportunities exist to make the plans better and more optimal. And this is one of those things that with recent legislation passed at the end of 22, which now gives retirement plans the capability to offer an additional catch-up contribution for, as you can see here, those aged 60 to 63. And so moving into 2025, if you turn 60 or any of those ages, 60, 61, 62, 63, during the plan year 2025, you can contribute an additional 50% on top of the normal catch-up contribution limit. In total, as you see outlined over here on the right-hand side, that's about $11,250 in addition to the traditional contribution limit that every other employee is held to. So all that to say, there's quite a bit of savings opportunity and capacity within 401k plans, and we're always on the lookout to make sure that you're aware of these opportunities that are coming on the forefront. And then Jake kind of mentioned earlier how we help employer partners and those participating in 401k plans understand some of the nuances of your retirement plans that you may not be aware of. For example, a specific contribution type called after tax. This is actually available in many different retirement plans, not just a 401k. It's been around a long time, but there are a lot of plans that don't necessarily use it on a regular basis. And with many of our clients, we have determined ways to incorporate after tax as a part of the plan, which really provides further enhancement to those savings capabilities. So wanted to break down just a little bit of what after tax is, just to kind of give you a feel for what this kind of education looks like. So this type of education allows you to exceed conventional limits. So we talked about that 23,500 limit. Well, after tax allows you to go above and beyond that. So say, for instance, you're a high wage earner, you're looking to save 10 or 15%, you want to accommodate that. This can be super helpful. Or maybe you just have extra savings that you're looking to add towards retirement and you've already maxed out your 401k plan. This gives you increased savings capacity. Unique aspect of this contribution type is it is different from Roth. They oftentimes get confused because they're both an after-tax contribution. Where they differ is on the earnings portion. Roth, by default, that will grow tax-free. On the other hand, after-tax, as a default, will grow tax-deferred, very similar to a pre-tax contribution. So hypothetically, in the future, if you withdraw these funds, you would pay tax on the earnings portion on the investment. However, when we're working with employer partners, we try to make sure to institute something called a Roth conversion feature. And what this Roth conversion feature does is it enables you to convert money such as after-tax earnings over to Roth, enabling these dollars to grow tax-free. You may or may not have heard of the term mega backdoor Roth. This is exactly what that is. It's basically a backdoor way to add additional Roth savings towards retirement, presuming that you take advantage of this Roth conversion strategy coupled with after-tax contributions. You'll also note here, there is quite a bit of savings capacity. We just mentioned how there are catch-up capabilities based upon your age. With the addition of after-tax contributions to certain retirement plans, this enables you to save even more towards retirement. The actual limit in 2025, it's called the annual additions limit. It's the limit of all contributions into a retirement plan between yourself and an employer, can go all the way upwards of 70,000. If you include catch-ups, like for instance, the super catch-up beginning in 2025, it could go all the way up to $81,250. So very, very high capacity to save with the addition of after-tax and 401k plan. Now, not all plans are going to have this. Again, this is where we strategize with our employer partners to make sure that it makes sense. In many cases, we'll find that there are plans that have caps instituted, either a percentage or a dollar cap. That has to do with discrimination and making sure that the plan is non-discriminatory. So we're always looking over compliance for these plans. So it may look different from one plan to another, but this is just one example of a nuanced aspect of a plan that we can provide some deep and high-level insights on. Transitioning, want to give you some high-level insights on long-term asset allocation, things you want to take into account when you are saving and investing longer term. Give you a brief market update here. Looking at the equity markets since the pandemic, so almost 5 years now, but about 4 years, a little bit more than that, we've seen some very strong returns on the S&P 500 specifically as an example. We look over the last 5 years, average annual returns right around 14%, which is very high. Additionally, we look at the last 12 to 13 months, we've seen right around 25 to 30% return. That can happen, and historically we've seen periods like this in the market, but what we've also seen is the equity markets tend to correct. On average, about every 1.2 years, or about every 250 to 300 trading days, we notice that the market has a tendency to pull back on average about 10%. So it wouldn't surprise us that in the near future that we see the markets pull back at some point. In addition to that, realistically, yeah, we're in a bull market right now, but is that always the case? No. Historically, we have seen recessions. They tend to be shorter lived relative to our bull markets like we have right now. If you look at history, average bull markets right around 52 to 54 months versus the average bear market, or periods where things are down, tends to be around 18 months. So we do anticipate continued volatility. Markets just hit another all-time high with President Trump being elected this morning. We've also seen yields increase, as well as we've also seen mortgage rates increase in recent months. So we do anticipate continued volatility. Now, with that in mind, when we look at the history of the financial markets, we note that that volatility is very normal. So it's important to put together an investment strategy that you can stick to over time, especially when times get tough, right? Because like I said, we anticipate that it will shift at some point. We don't have a crystal ball. We don't know when that's going to happen. But when it does, it helps to have tried and true principles in place. For one, just the understanding the value of investing, compound growth. Compounding, you can conceptualize it like the snowball effect. If you picture a small snowball rolling down a snowy hill, over time, this snowball packs on extra residual snow, and once we get to the bottom of our hill, we have an exponentially larger snowball. And similarly, that's how investing works. You put money to work inside of an investment, and over time, this investment has the opportunity to increase and grow in size. And it has those investment earnings that accumulate. I want to emphasize time here. Get rich quick is very difficult to do. Market timing is very difficult to do. Generally speaking, we want to think buy and hold, big picture, long-term as investors. That's very well illustrated on our example here, which is very linear. As you can see, it is possible when you allow time and investing to do its work that earnings can outweigh your individual savings into any investment account. This could be retirement plans. This can be just a traditional brokerage account, IRAs. In any case, you have the opportunity for those earnings to have exponential impact over time. Just to put things in recent context, if you look over the past 20 years, if you invested $10,000 in the S&P 500 all the way back in 2004 and didn't do anything with it and just left it where it was and let the market and the investments do its work, your money would be 5 times worth its original value. Big takeaway here, make sure we're keeping things in perspective. Day to day, just like we talked about in the market update, we anticipate volatility. There's always going to be a lot of noise out there. There's always bad news. Bad news, especially when it comes to the stock market, tends to sell. But generally, it is smart and prudent to keep your investments held and stay true to your strategy over a long term so that you can maximize your return and also minimize potential losses due to, maybe making a impulsive move with your investments. So make sure that we are keeping things in perspective, thinking big picture, long term. That kind of ties into some additional information we have here. For one thing, stay the course, emphasis on time in the markets versus trying to time the markets, kind of just alluded to that. And also picking an effective strategy and sticking to it. Dollar cost averaging is one of them. This is a strategy in where you invest equal dollar amounts on a consistent basis. This can be monthly, every single pay period of a retirement plan. It can be annually. But ultimately what you're doing is you're buying at high and low points of the market. And so that averages out your cost to invest. You can also lump sum. That's a strategy as well. At the end of the day, ultimately, I want you to be investing and prioritize that and make sure that we're doing that consistently and often as we can. Which strategy you choose is really up to you, but these are a couple of strategies that you might want to take into consideration. And then finally, investing, doing finances holistically can be a challenge. Do want to just make you aware, like we here at Newfront, we don't do any asset management or wealth management. We simply provide financial wellness resources to our employer partners and provide you guidance on steps that you can take. If you're interested in working with a professional one-on-one who can advise you on your specific circumstance to maximize your long-term financial potential, we'd encourage you to connect with a CFP, a certified financial planner. You can go to letsmakeaplan.org. This will actually pair you with a CFP in your locale, and you can filter it by planning specialties, so such as retirement planning, tax planning, income and benefits, estate planning, cash flow, you name it. There are several different areas that CFPs have the capabilities to advise on. And one other thing to consider, fee-only financial advisors. Fee-only financial advisor, this implies that they're only getting compensated for the advice that they give you. So they're not going to sell you, for instance, an insurance product or have you invest dollars with them. They're simply going to offer you advice on what you need to do, and then you have the responsibility to take those actions. So fee-only financial advice. If you want to work with an advisor who sells you some products, that's totally fine. Just make sure to do your homework. You can also find those advisors through cfp.net as well. So with that, I think we've entered the Q&A session. Jake, did you have any thoughts that you wanted to say?
No, I see Diane asked a question here to the group regarding, would you advise to be more conservative with retirement investments as you approach retirement age? And Diane, it's a yes and no answer. The yes part of that is that from a proper asset allocation perspective, modern portfolio theory, and then also sequence of returns risk and making sure that you don't end up in a position where you're retiring in a down year like 2008 or 2020, for instance, where you've seen 40 to 50% decline in your portfolio. The absolute answer is yes. As time goes on, you need to become a more conservative investor. However, everybody's retirement income situation is a little bit different. And so it's very possible for individuals to have different sources of retirement income. It could be a pension, whether that's public or private. It could also be from inheritances or windfalls. So security is also going to play into this as well, whether you're claiming early, on time, or deferring that out until age 70. And so there's a strong possibility that the retirement savings that you've built up in retirement accounts, you're not actually going to need to use those from day one or year 5 of retirement, in which case, perhaps you don't have to be as conservative as somebody that doesn't have a robust retirement income situation at that retirement age might, right? And so going back to Michael's point around engaging with a financial planner, this is why we would absolutely advocate for you to go out to cfp.net, find an advisor if you are a late stage saver. That's the nicest way that I can put that. Somebody that is further along in their career and getting closer to retirement age, because the sequence of returns risk is probably one of the largest risks that retirement savers face, meaning what is the right way to allocate my assets without knowing anything about what the markets are going to do, right? And so you really should be starting that decumulation or retirement income planning phase of your life well before you actually hit retirement age. Somewhere around 5 to 7 years is pretty much where you're going to hit the nail on the head, hit that timing right. And so it's a yes and no answer. It's a yes, that is proper fundamentals, but no, because not every single person is going to need to rely upon their actual retirement savings that they've saved in those first few years or further out in retirement. Great question here from Val. What are some common mistakes people make when planning for retirement, and how can they avoid them? Well, the first one, and Michael will appreciate this sentiment, and Michael, feel free to chime in here, but I would absolutely say treating your retirement savings account as a near-term savings vehicle and not actually looking at it as a long-term retirement asset. So think of things like taking loans or early distributions or hardship distributions from your retirement plans without finding another way to fund whatever it is that you're using that money for, right? Michael already kind of talked about in earlier slides about the effect of compound growth, smaller dollars being able to get you to retirement if you're starting earlier, right? And how much more punitive that can be if you're starting later. Just imagine if you're somebody that is poaching your retirement savings over the course of your career for whatever the reason may be. It's going to take you a lot more dollars to catch up on that and the missed earnings from taking that money out to actually hit that retirement. And that's more relevant for individuals that are going to rely upon their retirement savings as the largest driver of their retirement income. And so for me, that was absolutely mistake number one, is people treating their retirement savings vehicle like a savings account, which we absolutely tell the employees within our retirement plans to not do. But Michael, did you have anything else that you wanted to add to that?
I think that's a great point, Jake, because the retirement plan is not, a short-term vehicle. It is meant to be for your retirement. I think something else that might be a common mistake is overlooking the cost of healthcare and the long-term cost that tends to be in retirement. Recent study released by Fidelity shows that the average 65-year-old who lives until 95, retiring at 65, spends about $165,000 on average for healthcare. That equates to about $448 per month for the average person, or if you double that, that's roughly about $917 per month for the average couple. And so, a mistake you might make is oftentimes when you're retiring, you end up in a position where you don't have a mortgage to pay. Many of us have that opportunity to become debt-free, no more mortgage payment. And so we associate this level of new money with, oh, I can now live on this. And so I'm going to look for new opportunities to spend my money. And it's very easy to overlook the fact that, oh, wow, there's going to be this cost of healthcare. We're older, our bodies don't work the way they used to. They require a lot more maintenance. And so we have to have this we kind of have to budget for this amount. And it's just very easy to overlook that. And I think many people will find that they can still fund their retirement. I just don't want you to get, false hope thinking, oh man, now that I have this extra money that I can't spend, is that going to be detrimental? It truly does point to how important it is that you're planning early. And then one other thing I think that's super valuable to take in mind when planning specifically for retirement is thinking about your desired lifestyle goal. Oftentimes the question is, do I have enough money? What's the magic number? Do I need to have 1 million? Do I need to have 2 million, 3 million? And I mean, that's all well and good, but in a vacuum, it doesn't really tell us the right answer. What's better is understanding what your lifestyle goal is. Usually the easiest way to do this is to look through the lens of your current lifestyle. Whether you're living on 7,000 a month, 8,000, 9,000, 5,000, whatever that number is, and then kind of take a step back, look at it from a 30,000-foot overview and ask yourself, could I envision living on this in the future? Do I think I'll live on a little bit more? Do I think I'll live on a little bit less? That can set expectations for what a realistic retirement income goal looks like. And then you can back your way into, and there's calculators and you can work with a CFP to help you with this. You can then back your way into, oh, here's how much I need to save, and here's how much I need to have saved for retirement. So I think those are a couple things that people can easily overlook when planning for retirement.
Yeah, I think that's good. And then, the last thing in the kind of the parting words that I would leave on that particular question is something that you already addressed, Michael, which is around what we're seeing or what we're expecting even furthermore around volatility that is to come. I think probably another large mistake that we see employees making is treating their retirement account, whether it's an IRA or a 401k or any other type of a retirement vehicle, 403b if you're in the nonprofit space, so on and so forth, as a day trading vehicle. And they're actually looking at their 401k every single day, updating the balance every single day. And I think kind of going back to this slide, Michael, that we had showed on the screen gives you a perfect understanding of why this does not make a lot of sense to do this. If you wanted to do this on a quarterly basis or an annualized basis, would totally understand that. But paying attention every day is just frankly going to drive you a bit batty and probably a little crazy. And it's going to make you, unfortunately, do a lot of things that we see around human behavior in the personal finance space, and that is working against yourself. Flighting to safety and less risky investment options because you're worried about where the market's going to go from there. One of the kind of cliche things that we tell our employees inside our retirement plans is when markets go down, provided that you have a reasonable amount of time left until retirement, call it 5 to 10 years, that's a buying opportunity for you, right? You have the ability to pick up shares of that same investment option that you've been invested in throughout at a much cheaper cost than you were investing in literally just a month or two before that. And that's going to help to drive that account balance even further when the markets inevitably correct. And I think just taking a look at some of these big swings, the pandemic in 2020, the recession in 2008, they just look like blips on the radar now as we are looking at this over the course of a 20-year period. If you had not ridden this all the way back up, you would not be participating in the current market performance that we're seeing. U.S. capital markets right now, using the S&P 500, we're up over 5,900 as of today. And nobody had predicted that we would be there at the end of this year, but here we are, right? And so the point being is, if you think you have a crystal ball on this, I would argue you probably don't. And even if you were reasonably good at timing the markets, I'd say you're probably in the wrong profession. You'd probably be better off putting yourself into a portfolio manager's seat and earning a 7-figure salary. So for those average Joes that are out there that, really you need to be thinking about the long term, try not to look at this every day. It'll put you in a much better position to manage volatility over the long haul. What should we consider when choosing between different investment options? Okay, so I'll take this one first, and then Michael, I'll let you add into this. But number one, what is your acumen or savvy to be able to make investment decisions? Michael, this one will probably hit a chord with you, but we commonly get asked from employees, what's the right investments for me to allocate to and what the right percentage is? Or can you help me to come up with the proper asset allocation? The second that happens, we know that employees don't have the sophistication to be able to choose their own allocation, which is the reason that they're asking us for this. Inside IRAs, 401ks, 403bs, 457s, you name it, there are now modern day, what we call target date funds. They are age-based vehicles that are effectively just index funds, right? But they're hyper diversified across a varying set of asset classes, and they manage your account balance or your asset allocation over the long haul on your behalf. So when you're inside of your retirement plan, if you see age-based funds where they have the years next to them, I would absolutely suggest to you that you very likely, because 9 out of every 10 people typically should be doing this, should be considering using the target date fund. Okay, only about 1 in 10 Americans really have the sophistication or the savvy or the time to be able to pay attention to this with the amount of regularity that you would need to in order to manage your own allocation. Okay, so that's kind of the first thing that I'd lead off with. Michael, do you have anything you wanted to add to that?
I think you hit the nail on the head, making sure that you're leveraging the resources that have already been given to you that make it a lot easier, because Jake mentioned it. We don't all have the time. Heck, I don't have the time to go home and manage my own investments. So the average American falls in that boat. I think something else to add would be using your tools and resources. Many of your retirement plan providers give you free tools that can help you in your investment selection. They're not going to recommend what you should do, but they're at least going to provide you some information and help you and assist you in your selection. Also, like with some providers, you have the ability to continually rebalance your portfolio and set this up automatically to occur. If you are going to be more hands-on, if you're in that 1 in 10 American who is a little bit more sophisticated and spending more time with your investments. So that's something else to consider. And that's, one of the points that Jake mentioned when it comes to those target date funds. Those are automatically reallocating and rebalancing. They're a perfect set it and forget it tool. If you are going to be more hands-on, make sure that you're keeping track of how often you're rebalancing, because the reality is the markets are continually in flux and they're always changing. And you might have a portfolio that is 80% stocks and 20% bonds today, but within a couple of months, that could shift to 90% stocks and 10% bonds. And so having quarterly reallocations, or maybe just having a percentage reallocation set up in a system that can automate it for you, that's a type of tool that can help assist you if you're going to be a little bit more hands-on. And I can't emphasize enough, For those of you who do go down that route of being hands-on, make sure you're doing your due diligence and you're staying on top of it because you can very easily lose track of it over time.
Yeah. And the last thing that I would add to this is a common question that we get from employees, whether we're on site at a benefits meeting or Michael's hosting an employee webinar for them, is should I roll over my prior employer account into my current employer's account? Well, the short answer to that is probably. The longer answer to it is it's hard to say. We don't know where an employee is coming from. Now, they can, of course, share that with us. But not all retirement plans were created equal. And we know this better than anybody because we advise on these retirement plans and negotiate with the various providers for the cost structures and the overall costs that are being charged for the plan. That can include the investment related costs as well. If you came from a very large employer, there's a strong chance that the administrative costs, to the degree that you were having to pay those, were extremely low or perhaps non-existent altogether. So what's really incumbent upon you is to understand in the current account that I was in previously, where I have this amount of money that I'm considering rolling over, am I paying any administrative costs? Okay, that's the first answer. On the other side that I'm considering going to, am I going to pay those administrative costs? If you're not going to pay them on the other side, the answer is absolutely you should roll that money over because you're creating a more cost-efficient environment for yourself to be able to manage this account balance. All right. Now, if you have a balance in any prior employer's plan that is greater than $7,000, they can never force you out of that retirement plan. Okay. It's not allowed by law. And so you can stay in that plan that is cheaper for you if it turns out that the prior plan was charging you no cost and the new employer is going to charge you cost. So it's never an apples to apples comparison. The easiest way for you to understand this is either look at your prior quarterly statement against the fee disclosure for the new employer's plan, or just compare the fee disclosure for your prior employer's plan with the fee disclosure of your new employer's plan. And this is a document that not only has to be provided to you at the point that you enroll as a brand new employee with a new employer, but it has to be provided to you annually from the retirement plan provider. This also includes if you have an IRA as well. Okay, so these things have to be disclosed to you. We're all regulated by the SEC, and this is an absolute requirement, especially in the employer landscape. So I would tell you on a case-by-case basis, it truly is case-by-case. It's not always a yes to roll over, but sometimes it can be a no. All right. Any other questions there? Whether you want to drop them in the chat or... family childcare. What is your advice? My plan is my job because childcare has no retirement. Okay, so to make sure I understand, you are an employee of the family childcare, is that correct? You're the owner. I see. Okay. Well, here's the first thing that I'll tell you, Nisreen, is that if you're the owner of the of the family childcare, if you have do you have covered employees inside the organization? I'm assuming that you employ some, right? Or is it just you as a one owner and one employee business? No employees? Okay, just yourself. Michael mentioned this as a potential avenue for you, but yep, no problem. So one owner and no employees. So you actually have the ability to open a solo 401k or a SEP IRA as a self-employed individual. I would tell you that the easiest way to go about doing this would be call your favorite financial services provider that's known for being a low-cost provider, Fidelity, Vanguard, or whoever else that might be, Charles Schwab. They're all going to be able to structure a low-cost environment for you in these particular retirement plans. Tell them you're a self-employed individual, have them walk you through what your options are, and then you can compare and contrast those options, the costs. In most cases, account by account, the investment options are going to look very similar that you have access to. But the limits themselves and the tax benefits are going to be slightly different. Okay, so I would advise you as a one owner business and a one employee business to just reach out to your favorite financial services provider and have them kind of walk you through the ins and outs of that. On our side, we would very rarely, if ever, work with a one owner, one employee business because frankly, it just wouldn't make a lot of sense for us to do that for you, which is why we're kind of directing you out to go direct to the provider and kind of cut out the broker advisor. It's just not something that's needed for you at this stage in your business. Okay. One thing that I do want to mention to you though, is that to the degree that you ever end up hiring an employee or multiple employees, the state of California does have a state retirement plan mandate now. They've also, the state has stood up a state offered retirement program. You can go through that program. It is called Cal Savers. It's going to carry limits similar to the IRA marketplace, but they just make it a little bit easier for you and guide you through the process to set that up. It's also low cost to you as the employer, frankly, no cost because the employees are the ones that have to pay those costs directly. So that could also be an option for you to the degree that you end up inviting an employee or multiple employees into your organization. Michael, there was a question here from Deepankar regarding individual IRAs regarding the cap. Did you want to address that?
Yeah, I can address that. If you're speaking to contribution limits, there is still a limit for the IRA here in 2024. It's 7,000. It will continue to be 7,000 in 2025. For those age 50 and older, you can add an additional $1,000. There are income phase outs additionally for IRA accounts. For an IRA specifically, that phase out, if you're single, is 89,000 in 2025. If you are married filing joint, I believe it's 146,000. I think it's on the prior slide here, Jake. So yeah, it says it right there. Yeah, 146,000 for married filing joint. You're phased out of the deductibility. So IRA contributions, like say you contributed $5,000 here in 2024. When you go to file taxes next year, you'll see that $5,000 has been effectively reduced from your income. That's a tax deduction. That's what a pre-tax contribution does for you, or what a traditional IRA does. So you're phased out of deductibility if your income exceeds these limits mentioned, but otherwise 7,000 is the limit here in 2024, or 8,000 if you're age 50 and older.
Yep.
And then I saw a question earlier as well. What are index funds? Index funds are basically like a mutual fund, which is a collection of financial stocks or bonds all in one basket, right? And it pretty much just mirrors a market, such as the S&P 500, right? So we have index funds called S&P 500 index funds, and they literally, their asset allocation, their structure is very similar to that of the underlying index or benchmark that they are measuring up against. Therefore, this type of fund is what's called a passive investment strategy. In other words, they're not trying to beat that index. They're not trying to outperform it. They're simply mirroring its structure. Therefore, they tend to be very low cost investment instruments. You have very little turnover on the inside of the fund compared to like an ordinary mutual fund. In that case, you typically have a manager who's managing the asset on a daily basis. They're constantly making changes in that account. There's a lot of turnover there. Therefore, there's an incrementally higher cost to invest on the other side. So index funds are that low cost solution that tend to mirror a market or a benchmark.
Yeah, thank you, Michael. Deepankar, I also see that you're asking about the long-term care tax program like they've got set up in Washington. So two things. One, Washington is actually, they already have that program in place. They're also considering enhancements and updates to it. California, for the last 2 years, has actually had this on the docket. It is currently being evaluated. I will tell you, this is just something that I know peripherally because I work through the employee benefits and total rewards landscape with our clients. This is not in Michael and I's specialty or expertise as investment advisors. That is a question that would be better suited for an employee benefits broker, and advisor and consultant who we do have on staff. So to the degree that you have those questions, or if you're sponsoring an employee benefits program for your own company and you're curious about this, you can certainly reach out to us. We're going to actually be putting our contact information up here on the screen shortly. If you wanted to get connected to an employee benefits expert, you can just reach out to me directly, that jake.daly@newfront.com email address. And we'd be happy to get you connected with someone that understands that program very intimately. And we do have Washington-based clients that we work with where this program is relevant to them. So the short answer to that is California does not have it yet, but they are considering it. Any other questions at all? Okay, so we've gone ahead and put our contact information up here. I'll tell you, if you are an employer or a founder of an organization that does have employees and you have a retirement plan today or are considering standing one up, and you'd be interested to talk to us more about what a potential partnership would look like together, please reach out to me at jake.daly@newfront.com. I'd be happy to connect with you directly or connect you to anybody else on the team to the degree that you have questions around business insurance or employee benefits or anything else that is within the Newfront capabilities. So I'm going to go ahead now and turn it back over to Jeff Simpson, who will close us out.
Thank you, gentlemen. That was fantastic. Very informative. I know it made me want to take a peek at my own personal finances and make sure things are in order. I'm sure a lot of our guests and participants were thinking the same for their employees and their company plans. So as Jake mentioned, we really want all of you to think of Newfront and our team as a resource for you. Anything that you would like help on from a commercial insurance, business insurance, as Jake mentioned, employee benefits, administration standpoint, and then of course, retirement services, do not hesitate to reach out to the gentleman using their email on the screen, and they'll get you to the right Newfront representative. We've put a very large investment into our technology here at Newfront that we would love to show all of you and your companies how we can make your lives and your staff's lives much easier, and all things insurance much more streamlined. So final goodbyes. Really appreciate everybody today for spending some time with us. We hope it was informative. I want to thank Connect. They're an amazing partner of ours, and everyone please have a good afternoon. Thank you and take care.